Okay, we're going to take a look at our first split study and look at some actual numbers here. So to lay the parameters for the case, what we've got here is a 40-year-old male looking at an insurance company. Their 2020 dividend rate is 6.2%. We're going to fund the policy for 30 years. And we could go longer if we want, but we went 30 years from a simplicity standpoint. Nice stopping point. So we've got $20,000 per year for 30 years. And same company, same product, same age, health rating, everything's identical, but we're going to redirect where his money's going. The 40-60 split, we're going to have an $8,000 premium and a $12,000 PUA allocation. And then we're going to look at a 1090 split, which is as low as this particular insurance company will allow us to go, which is going to be a $2,000 base premium and an $18,000 PUA. So let's take a look. The first thing we'll do here is pull up this massive spreadsheet we have, or all of these numbers. And here we go. So we're going to look at the current dividend. So first and foremost, just to validate our Excel spreadsheet so we see everything going on, here is our base premium piece. We've got two things here. So when we say 40-60, we actually included the term piece here. So we've got just about $1,000 in insurance premium and then a $1,000 term rider. We put this on here to prevent the MEC from ever occurring. So there's our 40%, call it base or insurance expense piece. And then we've got the $12,000 PUA component. This company's term, AILR, stands for Additional Life Insurance Rider, another term for their basic PUA. So you will see in this model, $20,000 per year paid into the policy. Total cash value, if I look at my break even, just about year 9 there. At this point, I've paid in $180,000. I have $180,000. And then I continue to feed the policy. Quick side note, bottom right-hand corner, MEC limit, which funding it for a long period of time, where we eventually dropped the term rider, we did have to overinflate that in this example. That's why it's so high. The other thing though to mention, and you're going to see this on the Excel sheet, our overview video touched on this quite a bit, has to do with the dividend column. Remember, this dividend column is what? The company's surplus. So if their dividend rate is 6.2% and their guarantee rate is 4%, this would be 2.2. And the higher the base premium, the higher that number in that column will be. Important to take note of that. So then we're going to compare it with our 1090. Base premium, 10%, $2,000. Out of pocket for the consumer is exactly the same here, $20K per year. We have a term rider on this as well, but we stretched it for the full 30-year funding. It's a decreasing term rider. But here's my cash value. You'll already see the break-even point is year 5 instead of year 9. Good to be aware of that. Now, with that said, look at my dividend column. You might recall the 40-60 split had less cash value up front, but a higher dividend. Let's look at a direct side-by-side comparison here. This would be very interesting. So we've got the split study, $20,000 per year for 30 years. On the left, we've got our 40-60. Annual outlay 20, base premium component $8,000. So the total amount going in is 20K. Before we progress into the cash value and the cash value difference, let's look at this column. Annual dividend. Immediately, $12.25. The dividend, again, is the surplus. Remember, the surplus piece dividends are more favorable to base premium dollars. So this assumes if the company's dividend rate remains the same forever, which it won't, they always change, but if everything stayed exactly the same, this would be the dividend payout over time. And then the most important column, if I'm focused on the cash value, is this. That's how much money I actually have access to. That's what's going to gauge my actual growth over time. The death benefit, what's paid out income tax free. And the cash value difference here is meant to compare to the 1090 split. So as we look at this guy, 1090 split, same policy. We just looked at the detailed illustration. Premium piece, $2,000. Total out of pocket, exact same $20,000. Let's focus on the dividend here. This is the point that always comes up. Notice, 40/60 is illustrating a higher dividend. But what gives me more cash? The net cash value is the important column to look at, not the total dividend. It's relevant, but at the same time, the cash value, that's your equity, that's your money column. And it's pretty transparent here. I've got more of the 1090 split. $5,000 more right off the bat. So a higher PUA does generate more cash value in the early years. Let's look at it long term. Because we want to see, hey, does it make sense to go with the higher base premium if it generates me more cash over the long haul? I've heard this argument several times, so we decided to throw a study out there. This is part 1. 30 years into it, dividends were higher all the way through on the 40/60. So again, 40/60 is on the left. Here we've got the 1090. So okay, the dividend's higher, but at the end of the day, cash value is not that much different. Considering I've paid in $600,000 in total, that's how much out of pocket, $20,000 for 30 years for the consumer, went into the policy. But at what point in time does this generate me more cash value? It doesn't. And this is based off the current dividend. Wait till we get into the guaranteed study, then you're really going to see how everything functions. But here, I've got more money from start to finish. As I don't pay anything in, what happens? Again, pretty transparent. The 1090 gave me more cash from start to finish. So thinking long range, how do I beef up the long-term cash value and death benefit of a life insurance policy? Well, we can get the short-term and the long-term. It's just more so a case of understanding how to design the policy. And yes, every company is different, every product's different, but understanding the limitations. And if we set it up right, you can really set up a policy where you get the long-term benefits, but also you've got the short-term. So now when an opportunity comes up sooner rather than later, you can take advantage of that, use the cash, it's accessible to you. 1090, 40/60, 1090 is the winner here. Hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.